Welcome back, everyone. So just to recap, we just heard from David Roberts. He's the manager of the Nedgroup Global Strategic Bond Fund, and he shared many of his insights, which is seemingly unbelievable. Some of these things was happening in global bond markets that we're seeing globally at the moment. Next up, I'm very pleased to welcome Brian Coffey. He's a portfolio manager at NS Partners. They manage our Nedgroup Investments Global Emerging Markets Equity Fund. Brian, very warm welcome to you. So nice to have you back. How are you doing?
Yeah, challenging times, but always happy to speak to you guys and share our thoughts.
Yeah, as long as you're surviving these markets, we're very happy to hear that. Great. So, Brian, before we talk about all the volatility that we are seeing in markets, and there is quite a lot of it over the last kind of 3 weeks or so, can we please just touch on Q1 performance, please? And I mean, it's interesting in Q1 we saw the MSCI Emerging Markets Index outperforming the MSCI World Index, which great for the asset class. And what were conditions like for the fund, please?
Yeah, so it was a much better quarter in terms of relative performance for the asset class. So emerging markets up almost 3% during a period that the US was down. This was the period during which we had the surprise out of China of the introduction of their DeepSeek AI, which set the cat amongst the pigeons. The fund was up 1%, so it trailed the benchmark by 2% in Q1. That was mainly driven by weakness in AI-related names in Korea and Taiwan. So again, linked to that DeepSeek shock. But obviously, a return of 1% versus what was going on in the US and some of the developed markets is welcome. And as we'll see later on when we look at some of our slides, we're hopeful that the sustained outperformance of the asset class may be about to kick in after 15 years of very much a weakness period for EM.
And then, Brian, maybe if you can please just talk us through high-level attribution analysis of the portfolio, please, as well as if you've made any changes into the fund.
Sure, yeah. Well, as you can imagine, Anil, it was a very busy time. So we did make some changes in the portfolio. Just digging in a little bit into the relative performance, what worked and what didn't work. Well, what didn't work was stocks in India and Taiwan in particular. And South Africa was a challenge for the fund. We were underweight South Africa, and our exposure to financials lagged the gold stocks in that market. We were overweight Indonesia and underweight Brazil. And again, those were less than helpful for relative performance. At a sector level, the drags were the underweight in materials and our stock selection in industrials, consumer staples, healthcare, and financials in particular. What offset that somewhat was exposure in China and Hong Kong. So we had a very modest overweight there as that started to do well following the DeepSeek revelations. Our underweight in India, so although security selection was negative, the underweight in India and Taiwan were offsets slightly against that. Stock selection in Thailand and Malaysia worked well. And in mainland Europe, well, in Eastern Europe, our overweights in Greece and Poland helped performance. And the stocks that we had in materials. So in materials, it was mainly driven by gold stocks, and our exposure in China, which we'll talk about later, worked well. Also, our stocks in communications, utilities, and the overweight in consumer discretionary were positive for performance. In terms of individual names, three stocks that detracted from relative performance. We didn't own a Chinese company, Xiaomi, so we were overweight the market, but we didn't have exposure to Xiaomi. This is a mobile phone company which has now moved into electric vehicles. And their new car, the SU7, was very well received in China. They're selling very significant numbers of that. And although Apple tried and stepped away from EV, Xiaomi has shown that it is possible, and they're doing a good job there. We didn't have that. It's a very expensive company, and that was a drag on performance. Then one name that we have on the portfolio, which has worked well in the past, is Trip.com, a travel agency business and online booking service in China, but also in developed markets. And they had lower margins in Q1 reported, and that was due to increased investments in their non-China part of the business. We had a stock called 361 WAM in India, which is the fastest growing wealth manager there. But although they had decent results, India was subject to a bit of rotation as China outperformed. And the high valuations on 361 WAM were a negative during Q1. Things that did work for us, so we had Alibaba, the well-known consumer discretionary name in China. That took part in the rally as AI names in China did well. We had a Brazilian water utility. It's got a very long Portuguese name, but the shortened version of it is Sabesp. And Sabesp did very well during the quarter due to its strong growth profile. So they're starting to implement water sanitation initiatives all across the state of Sao Paulo, and they benefit from that. And then you won't be surprised, a third name that did well for us was Chinese, Tencent Holdings. This was a driver of the strong performance in part in South Africa, as it's owned by Naspers, but our direct holding of the company, which is what we prefer, did very well. And again, that was on the back of enthusiasm for AI in China following the DeepSeek revelations. Activity in the quarter at a country level, we added a little bit to China, and we took an opportunity to add slightly to the GCC, topped up some exposure in Brazil, and we financed that by reducing Indonesia. We took some profits in the Philippines, and we also trimmed Poland. At a sector level, we reduced utilities, energy, and financials, and added to IT, industrials, and consumer discretionary.
Thanks, Brian. And just, I guess, drilling a bit deeper into kind of the stock level, what were some of the bigger buys and sells that you did within the portfolio piece? I know there's always many interesting companies that you tend to be looking at.
Yeah. So, well, we have refocused in China on some of the names that we particularly like there. So we added to ICBC, which is one of the better SOE banks. We think the recapitalization of the Chinese banks points to a more positive period for them. We also added to Grupo Financiera Banorte in Mexico. Mexico seems to be navigating the tariff issue with the US better than we had anticipated. The market had sold off, as had the currency. So we felt the negotiations were going well enough that we should add to Mexico, and we took a position in Banorte. I mentioned that our strong performance in materials was due to a gold mining company. We bought Chifeng Jilong Gold Mining in China. This is a private sector gold miner and smelter, and it's the fifth largest in China by production and resources. So China is, well known as an importer of all sorts of commodities and materials, but it actually has significant domestic production as well. In addition to that, just not enough to meet demand. Chifeng was up over 50% in Q1, and so that was a positive contributor to relative performance. We added Hong Kong Exchange in Hong Kong. And again, this is a company that's starting to benefit from increased activity in the markets, both in Chinese names listed in Hong Kong and in new names listing there as well. So we took a positive view on that. And in South Korea, we added Hugo in healthcare. This is a cosmetics business which produces all sorts of pretty high margin cosmetics, including Botox, dermal fillers, and some skincare products. And we just think that the company has got a very good position within the global market. And financing those names, well, in China, we took profits in Eastrock Beverage, which is a consumer staple, energy drinks mainly, but we sold that down to finance the ICICI Bank and the other increases that we had in China. We sold Nari Technology in China. Again, this is a company linked to the investment in the power grid sector in China, and we saw that again to fund better ideas there.
Okay, thanks, Brian. And just, I guess, looking kind of beginning of Q2 and forward, and moving on to all the tariffs and related volatility in markets that we've been seeing related to that, like who would you say kind of stands to benefit the most and who stands to lose potentially?
It's our opinion, and it seems to be becoming more widely accepted that the US itself has the most to lose from these tariffs. So the US has the higher share of trade that's exposed to these tariffs, both from its imports and exports. The total is almost 20%. So that's a particularly high level of combined either reduced trade or higher cost trade. So that for us is the big weakness in terms of the global economy. If you look at China, it's got a much lower, almost below 3% in terms of its imports. The EU, Japan, and UK again are similarly low. So the US itself stands to we feel have the biggest impact from this tariffs that's going on. We're not concerned about inflation in the medium term as a result of this, and we are more concerned about the impact that it will have on economic growth in the US. So if you look at our broad money measures, you can see that broad money measures have recovered somewhat into 2025, but they're still around the same level that they were between 2015 and 19, which was a period that was deflationary. So our belief is that unless central banks accommodate the impact of tariffs and print more money, and the banking system delivers more money to consumers, then prices won't stay high for an extended period of time. But we may see reduced activity in terms of if you buy a more expensive car, then you've got less money for other discretionary purchases.
Yeah, I think that definitely makes sense. And Brian, I mean, you mentioned about the kind of medium-term inflationary impact. What about the longer-term inflationary impact, please?
That will depend on the monetary response. So if the central banks start to print, which would be similar to, we don't think this is a crisis, but if we see a response, a panicked response from central banks that print and accommodate these higher prices from tariffs, then that would be inflationary, and that would be very negative for the US. But the Fed has already hinted that with the market turmoil that they're concerned about the inflationary impact of tariffs. We think that's wrong, but we think it's right that they don't accommodate. So it's right that they take a more cautious approach until we see the total impact.
Yeah, thanks. I mean, you actually started talking about this already, but I really want to ask, what are your thoughts on the Fed and their role in all of this, and what do you think they're going to do and why, and what kind of makes sense to you from your observations, please?
Well, we keep an eye on the TIPS market and conventional yields in the US, and there's no signs there of any inflationary pressure. In fact, if anything, the indication for break-even inflation has come down slightly with all of this going on. However, I think what the Fed are concerned about, and we believe they're right to be concerned, they're concerned about the high level of US consumer imports, which would be exposed to these tariffs. So it runs at over 6%. And even with moderate tariffs on these, we're talking about tariffs of an average of 20% at the moment, although that seems to change on a daily basis. That would have an impact that would far exceed any benefit from lower energy prices. So we're also seeing, much lower oil prices, but that's a much smaller part of the consumption basket in the US, and therefore we think there could be inflationary pressure. Now, if the central bank doesn't accommodate that, then what we will see is slower activity. So you'll start to see, as I say, people adjust their spending patterns rather than inflation becoming a sticky issue. But central banks have been known to panic in response to weakening growth, so we should have to see how it works out. Yeah, so as I said, the Fed's response will be crucial. They always give a disciplined message to the market, but in times of extreme dislocation, particularly in bond markets, they capitulate and they tend to respond with interest rate cuts and then accommodating. So that could turn out to be in the medium term inflationary if that is the response. We're starting to see some signs. If you look at credit spreads, they have blown out fairly significantly since this has gone on. You'll see that in one of our slides. Now, against that, money numbers which we follow had indicated that the global economy wouldn't be particularly strong until the second half of 2025. So we weren't looking to a strong economic recovery until the end of 2025. So this tariff concerns is coming into a period that we think doesn't really justify panic action by the Fed, but we shall have to wait and see. We've already observed that despite tariffs being rolled back temporarily, that the bond market hasn't particularly responded to that. So we shall see where policy makers lead us.
Yeah, well, do you think they're going to lead us into a recession, or do you think that people's fears are a bit overblown at the moment?
So our economist Simon Ward has been tracking, long cycles of recessions, and he does a lot of work on that. We don't particularly claim, we certainly don't claim to be able to predict when the next recession will be. As usual, economists tend to have predicted 8 of the last 2 recessions. But there are things that we look for that give us, comfort or concern with regard to the outlook. Now, we think if you look at the cycles that attend normally a deep recession, that would be a combination of a weakening stock building cycle, business investment cycle, and a housing cycle. And we don't see trough years for those combining until 27, 28. That's really when we're going to see the possibility for that happening. That's not to say that it would happen then. It could be pushed out. Any of those cycles can be pushed out further from there. If we look at the stock building cycle, we have moved into positive territory there, and we don't think that the next down cycle there is due until early 27. So again, that's something that makes us think we're talking here about a negative impact from tariffs causing a slowdown rather than a deep recession. So if Chairman Powell sticks to his guns and remains disciplined, we shouldn't see a very significant inflationary impact across global markets, nor should we see a deep recession. But it's certainly not good to see the world's 2 largest economies look to disengage on a trade basis. So hopefully we'll see tariffs kept in abeyance for some time, although the uncertainty, again, is not helpful. So if you think of the business investment cycle, if you're a business, just the uncertainty of whether tariffs are going to be in place and how large they're going to be is going to postpone any investment decisions. So we think Mexico, as I said, we've added to Mexican exposure because we think they're navigating this particularly well. We haven't gone overweight because we don't think this is an environment where we're going to see a lot of further investment in Mexico. It's just not something businesses will do for some time.
Yeah, it does seem like it. Thanks, Brian. And I guess just, maybe on the US dollar as well, just typically it seems like a weaker dollar is positive for emerging markets. Would you say that's still true? And what is your research saying about the prospects for the dollar at this point?
So it's been frustrating us, as you know from our commentaries. We do think we're due a secular period of weakness in the US dollar. That's been the strength in the US dollar has been the main reason for the challenge, we think, to emerging market relative performance. And we've had underperformance now for 15 years. We've seen the dollar test some highs. So, whenever there's global disarray or heightened risk concerns, it is still a haven for safety. But it's retested its highs and doesn't seem to be holding up. So that could be pointing to the end of the period of US exceptionalism. And if you look at the weighting of the US in the MSCI World Index, that's at pretty elevated levels. So we think, a weaker dollar, a less attractive US market. So President Trump wants a lot of things at once. He would like a strong dollar, but somehow he would also like to be competitive in export markets, which doesn't really line up with the strong dollar. He would like to eradicate trade imbalances, but those trade imbalances are what leads to investment in US financial assets. That is the other side of it. So we think we're looking at a period which we had been expecting in any case of dollar weakness, and that should be positive for her. But it will be a rocky road, so as usual, markets will vacillate, and emerging markets are seen as a riskier asset class. So during times of heightened uncertainty, we may see reversals, but we think we're probably looking at the start of a period of sustained outperformance.
And then, Brian, I guess just bringing all of this together, how are you positioning the portfolio at the moment? And I say moment because things can change at any moment. So yeah, how are you positioning the portfolio, please?
Yes, it's very hard to say how you're positioned and feel that confident that it will be positioned exactly as that in 1 month's time, even given the current uncertainty. But at the moment for us, money trends are suggesting that Q2 or Q3 economic slowdown, it was on the cards even before this trade war shock. So that's why we've been cautious with respect to materials and other cyclical sectors. We think the inflation boost from tariffs will be small and temporary. And that's because the monetary backdrop is still pretty weak and disinflationary. Now, if authorities change that, then we will reassess that immediately. We think we've got relatively positive trends in EM and China in particular. So China has been holding back on its policy responses until it saw more detail on the tariff issues. And now we think they're more likely to start to stimulate their domestic economy. The overall excess money backdrop is neutral to negative. So that makes us favor more defensive exposures. We're looking at interest rate sensitive countries and companies because we think the response across global markets will be to lower interest rates as this economic weakness we had been anticipating starts to become visible. We're looking for beneficiaries of a weaker US dollar. And we've downgraded our highly cyclical markets. So in particular, we've reduced consumer cyclical exposure in both Taiwan and in Korea. We're negative on oil. Oil is at a very low level now. So we don't expect it to go, down to 40, although making predictions on the oil price is always like a very challenging affair, but we're negative overall on oil. And we think that the Chinese consumer will get stimulus from their government, and that's going to make that market more attractive. Not every sector of it. The other thing that's important to remember with China is China has been basically having to deal with a negative environment with regard to exporting higher margin products to the US for many years. So this is not something new. BYD is a company that we own in the portfolio. It's done very well. It doesn't sell any cars in the US, and yet it's now larger than Tesla in producing EVs. So we think China and a defensive portfolio is what we want. We're starting to add back to India. That has retreated in Q1, and valuations are looking much more attractive to us.
Brian, that was great. Thank you so much. We appreciate your time and all the effort that you and the team put into taking care of clients' money. So thank you so much.
Thank you so much, Anil. Speak to you soon.
Chat soon. Bye.